Welcome back to EDS, and in this video I'm going to show you exactly how to find high probability setups by writing options contracts and collecting a premium upfront. And when I say high probability, I'm talking about over 80% probabilities of success. So let's get into the step-by-step guide. So the first thing you want to do is pull up any equities underlying in your brokerage platform. It doesn't matter which one you choose. We've got Schwab open at the moment, and you want to simply navigate over to where you can see a list of expiration dates, option expiration dates for the underlying. All equities have the same option expiration dates. That's why it doesn't matter which underlying you pick, and we simply just want to pick an expiration date at this point. Now, the one that you want to pick needs to be between 30 and 60 days out in time. It also needs to be a monthly, not a weekly or quarterly expiration date. And as we can see here, the only expiration date that fits that criteria is February 21st, with 44 days left on the contract. So now we can take this information, come over to our watch list, and we can simply filter out any and all underlyings that have an earnings event in the next 44 days. And the reason for this is because we are selling these options contracts, which means we're short the options contracts. So we want to sell high and buy low. Now, as volatility increases, option prices increase, and leading up to an earnings event, volatility increases. So if we're in a position and we have an earnings event coming up, as we get closer to that earnings event, volatility will increase, and that's going to have a negative effect on our P&L. So we want to avoid that. And we also want to eliminate or remove any underlying that has a low liquidity rating level. We only want to trade liquid markets. The more liquid the market is, the tighter the bid-ask spread will be, and the spread between the bid and ask price is what you pay every time you get in and out of a position. So the tighter the spread, the less you pay, the more profit you keep. And that's why we do that. So what you'll be left with is something that looks like this. This is a pre-made watch list. You can use any watch list that you like. You can make your own, it doesn't matter. Just make sure you've got a nice selection of underlyings. This is just a default watch list that comes with the brokerage platform. I personally like to order everything from high to low IV rank. Again, we want to be selling high, buying low. So we want to sell when volatility is high and play the contraction back down to the mean. Volatility is contracting most of the time in the market, and it's one of our edges when you are trading in this style. So we simply go down the list at this point and see what would fit well in our portfolio. Make sure whatever you pick fits well. Don't be too heavy in any one sector or underlying. Use common sense and you'll be fine. You can use beta weighting, you can use correlation to the SPY, all this other kind of stuff, but for the most part, for most people, just use common sense and you'll be fine. Unless if you have a very healthy size portfolio, then you might want to use beta weighting and stuff like that. But for most people, just use common sense and you'll be fine. So you go down the list and you want to keep in mind the size of the underlying, what the IV rank is, what the absolute IV level is. Generally speaking, anything over 30 on the IV rank will be fine. And I've got my eye on GLD here, which is $246.10 per share. That's what it's currently trading at. And it has an IV rank of 54.3, which is nice and high, and an absolute IV level of 15%. So let's open up the expiration dates for GLD. And as we can see, we've got February 21st, which is what we're going to be going with. We already selected February 21st at the start of the video, which is 44 days out in time. So we're going to open that up, and now we can see the options chain here. So we've got our strikes going down the middle, and we've got calls on the left, puts on the right. This orange horizontal bar shows us where the price of GLD is with respect to the strikes. We've got a vertical orange bar here that shows us what the expected move is of GLD over the next 44 days. So how do we create a high probability trading setup? Now, if we already know what the expected move is, in order to get a high probability trade, we simply need to sell contracts outside of this expected move. Now remember, we are writing these contracts, we are short these contracts. So we don't want price to go anywhere near them. We don't want price to breach our contracts, our strikes. We want price to stay nice and far away. So what we're going to do is we're going to sell some contracts. We're going to sell one call and one put, and we're going to sell them outside of the expected move. We also have these dotted blue lines here that show us our standard deviation levels, and we also have delta here as well, which we can use. So we're going to use the expected move, standard deviation, and deltas, and all three of these things will typically line up quite well for every underlying on every position, and it's a nice little bit of confluence that you can use to make sure that you are entering positions correctly. Now, I personally like to be anywhere between 15 and 20 deltas on my positions. So we've got a 17 delta here on the call side at the 260 strike, and if you go over to the put side, we also have a 17 delta which sits at the 236 strike. So we've got a 17 delta on either side, which basically makes us delta neutral. We have a positive 0.34 delta, but that's negligible. It's basically delta neutral. And as you can see, our contracts are sitting outside of the expected move, and they are in and around the 1 standard deviation level, and we're between 15 and 20 deltas. So as you can see already, all 3 points of confluence are lining up, and we've now got this green bar here. And what this green bar shows us is our break-even zone, our profit zone, basically. So as long as price is within this green bar at the point of expiration, we will make money. Now, this green bar overshadows this orange expected move, which is going to give us a high probability of success. Now, how high is our probability of success? So if we look in the bottom left corner, we have a pop of 73%, and pop is simply the probability of profit, and that is the probability of making at least 1 penny on this position at the point of expiration. So at the very minimum, we have a 73% chance of success, and if we don't want to wait all the way till expiration and we want to get out at say 50% of max profit, we have a P50 of 83%. So we're looking at probabilities of success between 73 and 83%. This has just gone up slightly to 84 and now 86%. So we've secured a high probability of success trade. Now, how much money can we make off of this? Because at the end of the day, that's all that matters. So if we look in the bottom middle, we have this price here, which is $2.27, and that's our mid price. Now, each contract controls 100 shares of the underlying for equities. Now, what you do is to work out how much money you would make, you would multiply this out by the contract multiplier, which is 100, and you get $227. So as you can see here, we have a max profit of $227. It's just gone up to $228. So that's how much premium that we collect upfront as soon as this order gets filled by our broker, that gets added to our cash balance. Now, our broker is also going to require just under $5,000 in buying power to open this position. Now, you're probably wondering, $5,000 to open one position, that's a lot of money. And this is a lot of money, and it's probably not suitable for most people's accounts, especially if you have a smaller account. So I'm going to show you now how to still have high probabilities of success whilst being able to open a position like this in a small account. So what you simply want to do is use some of this premium to buy contracts further out of the money. So let's say, for example, we go $5 wide on either side. So we're short at 260, so we go $5 wider to 265 and we buy that contract. And then we do the same thing on the put side. We're short at 236 and we simply go $5 wide and buy the 231. And what we've basically done here is we've created a spread on either side. We've created a call spread and a put spread. Now, as you can see, the premium that we collect is slightly less upfront, and that's simply because we've used some of the premium to pay for some contracts to cover our short contracts. Now, as you'll notice, our buying power requirement has significantly been reduced. It's no longer $5,000, it's $393. So we've massively reduced our buying power requirement, and this amount of buying power is much more suitable for smaller accounts, and pretty much every account should be able to fit this in nicely without any problems. Now, what you'll also notice is that we collect $108 or $107 up front, and our buying power requirement is $393. So now we have a much higher return on capital. If we look at our probabilities of success, we have a pop of 68%. So our pop has slightly reduced. However, we have a P50 of 83%. So our probabilities of success are still extremely high. And we now also have a much higher return on capital, and this can fit in most portfolios, or almost every single portfolio. Now, what we can do is we can be slightly more aggressive with this being a covered position. Let's say if we go to the 20 delta on the short side, it's going to be a bit difficult because the strikes go up in lots of $5. So let's just say we go to the 255 strike, which is at 27 deltas, which is slightly more aggressive than what we want to be. But I'm just going to show you some magic here just to make a point. So we're at a 27 delta at the 255 strike. Remember, we still want to be only $5 wide, so we're going to move our our long contract to 260. So we're still $5 wide on the call side. And we're going to do the same thing on the put side. So we're going to move our put contract to the 25 delta, and we're going to adjust our long contract, still keeping $5 wide. 1, 2, 3, 4, 5. So we've still got a $5 wide spread on either side. We've just increased our deltas on either side, and what that has done is it's increased the amount of premium that we collect up front, and in turn our buying power requirement has been reduced. Now, how do we work out our buying power requirement? It's based on our max loss, and our max loss is based on the spread between our two contracts minus the premium that we collect up front. So it's that spread is $5 minus $1.80, because that's the premium. You multiply that out by 100 because of the contract multiplier, and you end up with a max loss of 319, and that's what our buying power requirement is. And our broker only needs to hold whatever our max loss is to cover us in the worst case scenario. So what you will notice is that we have a even higher return on capital now. However, our probabilities of success have reduced slightly. Our pop is now 55 and our P50 is 68%. Any trade with a probability of success over 50% is a high probability trade, and we're looking at between 55 and 70% probabilities of success on this trade, which gives us a very high return on capital. If you were happy to take slightly less return on capital but you wanted higher probabilities of success, you can simply just reduce your deltas. Let's say you go back down to 20 delta, you can just simply reduce your deltas. You can make the width whatever you want. It just depends on the size of your portfolio. Let's say if you just wanted to make it $2 wide, right? So $2 wide on the put side, $2 wide on the call side. We collect 63 cents up front. Our buying power requirement is now only $137. Our P50 is 75%. And this is how you can find and manipulate positions to fit inside your portfolio to give you high probabilities of success. And you can do the same thing for any underlying. It doesn't matter what the underlying is. Any underlying, you follow this, and you can and it will work for every single underlying. The numbers are the numbers, statistics are statistics, standard deviations are standard deviations. The only thing that you need to do is make sure that your position sizing is small enough so that no one thing can wipe you out. We're basically operating casinos here. We're operating like a casino, like an insurance company. You want to keep your positions very small so that nothing can wipe you out, and you want to have as many occurrences as you possibly can. Now, this is simply because short-term variance can sting you, you can get lucky, but we're not interested in short-term variance, we're interested in long-term profitability. And the way you can guarantee long-term profitability is by having as many number of occurrences as possible in order to let the statistics, your odds basically to work in your favor, and just let things play out as they should. The only way that you'll get stung by doing this is if you go way too heavy, if your position sizes are too large, and you get wiped out by short-term variance. As long as you're managing your position sizes and you can stay in business and you can keep writing more contracts over the long run, you will make money. It's simple maths, it's statistics. Now, how do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a free position sizing template that's available for everyone to use. Link is in the description. Once you click that button, it will take you over to a spreadsheet that looks like this. You enter in whatever your portfolio size is, you then enter in whatever the current VIX level is, and everything will then be automatically calculated for you. It will tell you the maximum amount of buying power that you should be allocating to single defined risk positions, undefined risk positions, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this spreadsheet, over the long run you will be absolutely fine. No one event can wipe you out. And that, like I said, the link for that will be in the description. If you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium, get yourself signed up. Inside you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so you can speak with myself directly or with other like-minded individuals if you get stuck at any point. There's also a 100% money back guarantee. So after 6 months, once you've gone through our course and followed our trades, if at that point you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free for you, and it's £1 a month to join. It's so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are rewarded for getting in early, and the aim of EDS Premium is to get you to a point where you've learnt the skill. You know how to write contracts, you know how to manage risk, you know how to make adjustments. It's something that you've learned and no one can ever take away from you, and it's something that you can do for the rest of your life. And we aim to get you to that point within 6 to 12 months. You are always welcome to stay and be a part of the community. However, 6 to 12 months and you should be good to go. So with that being said, I will see you guys on the inside.